traders at UBA say the recent lack of offers on government bonds suggests skepticism from the market that the debt management office may overissue at its month auction. Dumebi Udegbunam, a fixed income trader at UBA, joins me now to discuss the details of that auction and the broader fixed income market. Dumebi, thank you so much for your time. And first of all, let's just unpack your expectation. All right, let's now, first of all, unpack your expectation about the potential for the debt management office to overissue here. And what is guiding that expectation?
So basically what's guiding that expectation is where rates are currently in the market. So if you look at where the last auctions on the 2036 and 2050 closers, the 2050 closed at 1325, the 2036 closed at 1315. Currently market was trading as low as 13. So they're going to take advantage of lower rates or lower use in the market, mainly because of their cost of borrowing. So it's cheaper for them to borrow at current lower rates, and then they will take advantage and probably oversubscribe. Mind you, the domestic debt borrowing for the countries, we have about 2.4 trillion. Already 1.9 trillion has been raised. So the remaining 600 billion, this will be the right time to take advantage of where rates are and oversubscribe their bonds.
But can you just explain how much lower rates have come down that you suggest that they are going to take advantage of this? To what extent have things changed since the last auction?
Okay, so if you do a 1 year trend for where 2050 was at around this time, 2020, even 2019, they were as high as 14 levels, 14.15. So if you do a 1 year trend analysis, you will see a sharp decline in rates, and therefore we are suggesting that the market could probably close around 12.95 levels at the 2050 auction. So definitely that's a win for them at the DMO, owing to our cost of borrowing, which has been increasing. Our cost of borrowing right now is at, let's say, 97% compared to our debt to revenue also.
Obviously, I know the banks would have to invest in many of these government securities, but for institutional investors, are we seeing maybe a hesitancy around investing in the longer term instruments, considering the current inflation rate?
Yes, definitely. As you all know, despite we've had a drop in inflation to 17.38, if you compare to current use in the market, we're still at a negative rate of return. If you put into the formula or into the model our current exchange rates, give or take, our negative rate of return has increased by about 25% year to date. So yes, there's a hesitancy. However, there's liquid funds with the PFA, so you rather would want to invest than have outdo funds which are yielding you nothing in the market. So yes, there's a hesitancy. However, like I said, the DMO actually has read this market well and is taking advantage of current use in the market.
All right. What are your expectations for subsequent bond issues, though? Because as you know, the government has been talking about a huge deficit this year. Recently, we even heard about the extent to which the government has been borrowing money from the central bank. Well over 2 trillion naira so far this year. So that speaks to the challenges that we're seeing with the government in terms of its revenues and the needs to borrow. Do you think that could impact the local debt issuance moving forward?
Yes, that could impact. That's why if you notice, about early this month, they brought out the framework for the Euro bond, about 6 billion to be raised, which is the highest Euro bond we've seen issued in the last 5 years. So they're trying to have a perfect balance of domestic debt borrowing and foreign debt borrowing to try and ease out the debt servicing and debt to revenue ratio. Currently, our debt to revenue ratio is at about 98%. So we're looking at it from two angles. One from the revenue angle for the government and also from the debt angle. So going forward, we might keep on seeing lower rates in the market short term. However, the view long term going into Q4 is an upward trend in yields.
So obviously the debt management office will try to read the market, but what are your expectations? At what yields do you anticipate we would see when they issue these bonds?
So basically, well, one thing I would bring into this conversation is the current illiquidity in the market. As we speak, as of today, we're at a negative 10 billion in the market right now. So that too would play in where we might see market sentiments. If by resumption of next week or by Friday, if after the FX retail auction and the debit of the bond auction, we might actually see an upward tick in yields marginally. So that too will also play where we see yields going forward. So all this put into the whole conversation, we will expect mixed sentiments in the market too, and the DMO would read into all these individual entities and see where to put a good rate at the market, owing, like I said earlier, to the cost of borrowing.